Confidence is wonderful in the gym, in interviews, and when ordering food for a group. In investing, confidence without a margin of safety is just a more expensive way to be wrong. Graham ends The Intelligent Investor by distilling the secret of sound investment into 3 words: margin of safety. This is not a decorative phrase. It is the operating rule behind the whole book. This is an educational book summary episode from The Intelligent Investor by Benjamin Graham. Today we are using margin of safety to connect the whole book into one practical rule. A margin of safety exists because the future cannot be known precisely. Earnings may disappoint. Interest rates may change. Management may allocate capital badly. The economy may turn. The investor may simply be wrong. Graham's solution is not to pretend these risks can be forecast perfectly. His solution is to build a cushion. In bonds, that cushion may come from earnings covering fixed charges many times over, or from enterprise value standing well above debt. In common stocks, the cushion is more complicated. It can come from a reasonable price compared with earnings power, strong assets, conservative financing, diversification, and a purchase price that does not require perfection. Here is the framework. Margin of safety has 4 practical layers. Layer 1. Business strength. Does the enterprise have durable earning power, or is the thesis built on a temporary boom? Layer 2. Financial strength. Can the company survive ordinary stress without depending on friendly markets? Layer 3. Price discipline. Even a good business can become a poor investment if the price assumes too much future success. Layer 4. Portfolio construction. Diversification is itself a margin of safety against our inability to know which specific decision will fail. This is why Graham's book is not just about cheapness. A stock that has fallen is not automatically safe. A low valuation with weak finances, unstable earnings, and poor governance may be a trap. Margin of safety is evidence plus price plus structure. The illustrative case study is simple. Suppose 2 investments both look attractive. One requires everything to go right: high growth, stable margins, low rates, and enthusiastic market sentiment. The other can still produce an adequate result if growth is slower and sentiment is ordinary. Graham would push the investor toward the second kind of setup, because it depends less on being exactly right. This connects back to every episode in the series. Investment versus speculation protects the label. Defensive allocation protects behavior. Mr. Market protects emotional independence. Earnings skepticism protects analysis. Margin of safety ties them together by asking, where is the cushion if I am wrong? For a practical research process, the final checklist is blunt. Before buying anything, write the margin of safety in 1 paragraph. Do not write, good company. Do not write, long-term story. Write the actual cushion: valuation, balance sheet, earnings coverage, asset backing, diversification, or conservative assumptions. If the paragraph sounds like hope wearing a blazer, keep working. Graham's deepest gift is not a formula. It is a temperament: be skeptical without being cynical, patient without being passive, and rational without pretending to be emotionless. The market will always offer noise. The intelligent investor's job is to build a process that does not need the noise to become wisdom. That closes this series on the intelligent investor. If you remember only one thing, remember this: the future is uncertain, so your process must be built with room for error. Thanks for listening. If this episode helped you look for a cushion before trusting your confidence, that is the real goal. And outside the market, please give yourself some margin of safety too. Sleep before you become a dramatic email, eat before your mood starts filing complaints. Life is easier when basic maintenance is not treated as an optional upgrade.